In the beginning, if you don't have $1 million to start
Yeah.
investing in on day one, you don't have money to trade. You're going to have to. We realize this is actually the time to be buying. We're going to realize a crap ton of appreciation. We're going to make really, really good returns. So that's why we decided that it was a good time to buy into. So is probably 50% of my decisions when I'm investing. Most people are looking at trying to make as much money as quickly as possible. For me, I'm looking at how can I safely make as much money as possible. You do have to stick to the fundamentals. I know I sound like a broken record, but that's just the truth. You know, I'll be honest with you, and maybe I shouldn't say this, but typically in this market, if you can't get a good deal, then I know nobody wants to hear this, but seriously,
Yeah.
if you have to pay $40,000 over asking and you're concerned about it, then just what's going to happen? And I will give you this one for free. And I literally just gave it for free on my own podcast the other morning, where someone asked, well, what's next then? And I said, fine, I'll give it to you for free. I'll tell you exactly what investors are going to do next.
Welcome to the Wealth Through Real Estate show. Today, we have a returning guest who's no stranger to the world of real estate investing. If you've been following the Canadian real estate investing space, you've probably heard of him. He and his wife, Gabby, have coached over 300 investors, built a thriving portfolio, and are the founders of Real Estate Investing Masters. We're joined by none other than Wayne Hillier. Wayne, I want to welcome you back to the show. I'm excited to have you back on.
Thank you so much for having me back on, man. It's a lot of fun. I'm excited to get into it.
Okay. Now, Wayne, just tell me off the top of your head, since our last conversation, have you explored any new strategies to sort of add into your portfolio? What have things been looking like on your end?
When was I on the podcast?
It's been a while. Probably, I want to say like a year and a half ago.
2022,
2 years
2023?
maybe?
Well, a lot's
Yeah.
changed. A lot has changed in the market, especially in the markets that I invest in. Obviously, you know, I invest in Alberta. So I invest in Calgary and I invest in Edmonton and Leduc. And a lot has changed in the Calgary market at the very least, because since 2022, obviously, we've seen anywhere from a 60 to 75% increase in value there. So we've done very well there. And then in Edmonton as well, it was pretty the same for a while there up until recently in late 2023, 2024, and now into 2025, we're starting to see some significant changes there, and in obviously Leduc as well. So has my strategy changed? Well, you know, I always shift and adapt with whatever is going on in the market at that particular time. So, you know, you might have
Yeah.
seen me doing fix and flips in 2022, and I'm not doing fix and flips right now. That's nothing, you know, personal about any of it. It's just you do what works with whatever conditions
Yes.
are in that market, whatever cycle you're in. So we have shifted quite a bit. I'd say 2023, we actually got away from the buying and selling of real estate, because I was actually in the process of selling quite a bit in 2022. And we even offloaded some of our underperforming properties. And then 2023 came and we started noticing in the spring market there that, hey, wait a second, I think it's finally happening. I think Edmonton is finally, we're realizing this, what we've been waiting for since 2016. And so we actually got back into buying mode, and we completely shifted everything, and we started getting into buying rental properties. So the answer is yes, actually, we've been shifting quite a bit, but not any like progressive or progression towards something we know more. It was all about just adapting to whatever the conditions of the market were.
So the decision to make that shift, was it more based on, hey, we're in an inclining market, yes, fix and flips work, but we'll see a lot more upside if we just buy, hold on to this and ride that wave up?
Yeah, well, I mean, obviously it's always, you can't just say it's an up market or a down market, or a cycle or a down cycle. You know, we also had to take into consideration interest rates during that time. And that was a whole
Yeah.
new thing that people have never really dealt with. We were in an inclining market with high rental demand and extremely high interest rates. So what do you do with it? You know what I mean? This is
Yeah.
probably one of the funnest experiments or case studies that I had ever had to deal with, was what do you do in a market like that? And through a lot of deep analysis and looking back at the history of real estate in Alberta and in Canada, we were able to recognize trends that kind of mimic this. And we realized this is actually the time to be buying rental properties. This is the time to be buying cash flowing rental properties that can cover the borrowing costs, the monthly expenses for that rental property, and have that cash flow, that buffer. And then wait out for the potential upside. Now, we didn't know for sure whether there was going to be upside. It was all, you know, that's the speculation part of it. But we knew
Yeah.
that if, at the very least, if we bought a good cash flowing property that was able to cash flow and make money regardless of appreciation or not, and regardless of the high 6% interest rate, then we're okay. Worst case scenario, we're going to make money. We're going to make 15% ROI per year. Not a big deal. But best case
Yes.
scenario, we're going to realize a crap ton of appreciation. We're going to make really, really good returns. So that's why we decided that it was a good time to buy into cash flowing rental properties at that time and get away from the buy and selling of the fix and flipping.
What are some key metrics when you are sort of doing that in-depth research to sort of see where the market's at and kind of speculate and predict what the future holds? What are some key metrics that you sort of diving into to sort of research and understand it more on a macro level?
Try and put it as simply as possible because it is very complicated and it takes a lot of things into consideration. Obviously, the economy. You got to take into account the economy and job creation in your area. That's super important because you want to make sure that if you're buying long-term, buy and hold cash flowing properties, it's long-term. You should
Yeah.
be planning for 10 years, right? You don't plan to make $40,000 worth of appreciation and then just sell it in a couple of years. And then what are you going to make after you pay realtor fees? It has to be for the long term. You make your money
Yeah.
in real estate in the long term. Now, with that also, you had to take into consideration, what did we think was going to be happening with the interest rates? Did we think that they're going to be coming back down? Is it going to be staying at 6 or 7% for a long time? So we took that into account. Then we looked at the history of Alberta. We looked at, all the way back to 2004. And I'm going to talk about specifically in Edmonton right now, looking back to seeing the rise and then the 2008, housing crisis and then the fall and then the
Yes.
rise up to 2015. And then in 2016, the oil price crash and the fall and then the rise. And then 2019, everything's looking really good. And then 2020, pandemic crash. But each of those
Yeah.
individual catastrophes were very unique and they weren't the same. You know what I mean? The
Yes.
subprime
Yeah.
mortgage nonsense in the US and a little bit in Canada is very different than the COVID-19 pandemic, is very different than oil
Yeah.
prices crashing and stuff like that. And then, you can even take into account the catastrophe of 2023 and 2022 of interest rates. They're all very, very
Yeah.
different. You gotta
Yep.
have to look at it all and just like, how long is this going to last? How are things going to rebound? And ultimately what I'm looking at is I'm looking at consumer behavior. I'm looking at tenant behavior, I'm looking at home buyer behavior, and I'm looking at investor behavior, taking all that into account. And when things start normalizing and then maybe shifting, how is everybody going to react to that? And that'll give you a good indication of what you can kind of predict is the next thing or what you should be putting your focus or your marketing and energy into.
Yeah, that makes a ton of sense.
Does it? Okay, because
That
I
makes
was really worried that
ton
it
of sense.
didn't.
No, it does. It does. And I think it's easier said than done because there's a lot that goes into, understanding all of this. And you're right, there's a level of unpredictability to it because, who would have predicted COVID and those sort of things. Now, for people trying to get a better understanding on assessing the risk, how has your understanding of risk evolved as you've gained experience in, call it the Edmonton market at least?
I learned a lot in the first 5 years. I think in the first 5 years of investing, I was following what other people were saying, which is fine. I don't have any regrets. I didn't know what I didn't know, and that's okay. And it's perfect okay for everybody else to do that as well. You follow what you think is the right thing to do. You take the opinions of other people and you run with them. You try and make the best decisions you can, but until you're actually in the game, and especially until you've bought and held properties and managed them for a little bit of time, you'll start to notice you'll start to learn things along the way. And, I have so many great examples of just different lessons that we've learned along the way and, how we've put new measures in place in order to mitigate those risks or to manage those risks, moving forward. So risk management is probably 50% of my decisions when I'm investing. Most people are looking at trying to make as much money as quickly as possible. For me, I'm looking at how can I safely make as much money as possible with the least amount of risk. And then once I've established and identified what that risk is, what additional measures can I put in place to manage them, to keep them as low as possible? And then from then
Yes.
on, how can I make my business more effective and efficient? Right. So risk is huge for me. It's very, very important to me. And I don't think enough people put enough emphasis on it with their business. I don't think actually people look at real estate investing enough as a business. I think that people just look at it as like, I'm going to buy something and I hope it goes up in value. They're not taking all these extra things into consideration about the management and the running of this business. When you buy a piece of real
Yeah.
estate to rent out, it's a business. You're generating revenue. It's not like you're buying a piece of
Yes.
gold and hoping that it goes up in value. You are buying an
Yeah.
asset, which you do hope it goes up in value, right? And real estate's great for that. But you also have to understand that this is also operating as a business. I'm renting this out to tenants. They're paying me rent, and I need to manage that side of the business as well because there's profit in there. There's profit in generating revenue, rent, paying down the mortgage, cash flow. There's different areas that this business can profit. But if I'm not putting in the necessary measures and systems, then that side of the business could be at huge risk and vulnerable to
Yeah.
losing money, which can kind of offset the money that you made in the asset appreciation. You know what I mean?
Absolutely. And you 100% right. And I think a lot of people have the assumption that it's passive, right? And if you're the money partner, yes, it's a lot more passive. And then you're not running the business because you're not managing it all. But if you managing the real estate, your clients, your quote unquote clients are your tenants. The clients are your joint venture partners, your money partners. You have a service that you're offering. You have a product, which is the real estate. So it is a business and there's systems involved and you want to run it as efficiently as possible so that you can maximize your return. Now, what are some things that you found, systems, efficiencies that you've put into place to sort of streamline and maximize your real estate business?
You know what? This is like my wife's side of the business. This is funny that you asked. Well, and I wish in situations like this, and people ask questions, they listen to podcasts, they're looking for like that gold nugget, like, oh, wow, I really want to add that. And to be honest with
Yeah.
you, I don't really have anything that really stands out as like, that's the one thing that like, this is going to be El Ray's big clip and he's going to bleep it out.
Yeah.
And you know what I mean? This is the number one tip for reducing your risk and making your business more efficient. Bleep. Like, it's
Yeah.
to be honest, it's just little things, about like refining our lease agreements. It's about
Hmm.
refining the way that we screen our tenants. I talk about this a
Yeah.
lot on our own podcast. And that's like so many people will put different barriers in place in order to protect their time in their business. Like, say for example, you put a rental listing up. Well, in the rental listing, it says that you need to call me for a pre-screening interview. I want you to pay $30 for a single key application. And once I reviewed all of this, then I will let you see the rental property. Who's going to do that? Like, why would anyone go through all those hoops when the next person that they respond to says, yeah, for sure, I can show it to you in 30 minutes. Do you think they're going to go through all
Yeah.
those hoops and pay $30 for that? No. So what it was
No.
really what it was all about was removing as many barriers as possible and then
Yeah.
adding in extra measures on the back end to make sure that we are covering our ass. But ultimately, what I want to do is for tenant screening and for finding tenants, I want to make the process as seamless and simple as possible compared to my competitors. And then on the back end, I add extra safety measures just to make sure we're covering our butts. But ultimately, in
Hmm.
order to do that, what you have to do is you have to give up and devalue your personal time. And I think that a lot of real estate
Yeah.
investors through various different webinars and books and stuff like that, they say, value your time. Your time is worth $1,000 an hour. You should be focusing on the $1,000 an hour tasks and not the $15 an hour
That's a
tasks,
$15.
right? And
Yeah.
by thinking that way, what you're doing is you're making your business less efficient. So when I'm doing stuff like that,
Yeah.
I just agree that my time is worth $15 an hour and I'm willing to do whatever I would expect someone to do for $15 an hour, right? If I were hiring this out. So there's that. And
Yeah.
then there's different like agreements and stuff like that. We really, like I said, we polished our lease agreement, our communications agreements, how we handle our security deposits, how we handle our cash flow, and how much money we put into the reserve from our cash flow. And just making sure that this business is as sustainable as possible so that we can weather any potential storm that comes in. And that could be vacancies, extended vacancies, having no tenants in, reduced rents,
Yeah.
increased interest rates, potential global pandemics, oil price
Yeah.
crashes, value of our properties just dropping 10% overnight. Anything that can potentially happen, our business is weather and storm proof. Nothing can stop our business because we have all those reserves in place. We have all that cash flow and we've got all of these systems in place in order to protect ourselves.
There's a few things that you mentioned there that I want to unpack. So, um, the first one would be on the Not the number one tip that's gonna transform your business. I like that. It's not, selling the shiny thing, but it is refining things. And this is one thing Amazon does well, is removing as much friction for the customer as possible. So I like that, from the tenant being your customer. How can you remove as much friction as possible without sacrificing on the screening, so that you ensure that you put a good tenant in and actually have a good experience with your rental properties, as opposed to getting bad tenants in and having to deal with all the aftermath of that.
I'm really glad you brought that
Yeah.
up, because I use the example of Amazon Prime all the time when I'm talking about finding
Yeah.
tenants. I love using that example
Yeah.
because I want to be the Amazon Prime.
Yeah.
I want to be, so when you go and
Yes.
you look up a new podcast microphone, you know what I mean? You're going to have an idea of like a price range that you want, how much money you want to spend, and you're going to type in podcast microphone. Now, if they're all the same and they're all relatively close in price, what do you do next? You click on the Amazon Prime button. How can I get this as
Yeah.
quickly as possible? Right? And
Exactly.
some of them are going to be next
Exactly.
day, and some of them are going to be between 4 a.m. and 7 a.m. the next morning. That's perfect. Then I could use it tomorrow morning. That's exactly what I need, right? That's always, and I will pay a little extra for that. So if I can use that same concept for when I'm trying to fill my vacancies, then everyone will go with me because I'm the easier one. Now, on the back end, I'm going to put everything in place in order to make sure that I'm still protecting myself. But I want to get as many eyes on my product as possible so that I can choose which
Yeah.
one I like, as opposed to having to fight over price.
Yes, I love that, because it increases your pool of applicants. So then you can sort of pick from the best then, right?
Absolutely.
So no, that makes a ton of sense. It makes a ton of sense. Now, I have a question for you with regards to, because I love the fact that you brought that up, was, the value your time, $15 an hour task, versus like $1,000 an hour task. What would you have to say for people who are listening to that and are like, but Wayne, how do I scale up if I'm doing all of these smaller things? Does there come a point where that becomes a sticking point? Or do you recommend that I do this enough times that I fully grasp and understand the process, and then I can then better delegate it versus just abdicate it and just pass it on to someone else and just assume that they're going to do it the right way? Or is it something that I have to continue doing and just never give that up, kind of thing, and just get to a sticking point and not scale beyond that? And should I just focus on getting to a certain number and just stay in there?
I'm so glad that you brought that up, because after I said it, I'm like, oh, everybody's going to assume that I think the $15 an hour tasks are so important. No, actually, in fact, it's only finding and screening tenants that I will do those jobs, because I personally believe that when it comes to finding the right clients, and this is a huge, when we start assessing risks in our business, who I put in and who I lock up on a 12-month contract for a lease is extremely important, because once I give them possession of my property, they now have legal possession and I cannot physically remove them. So this is a very, very
Yes.
important part of my business, to make sure that at the very least, I want to be involved in the people that are actually inside my property, because I cannot take possession back very quickly. Now, Alberta and Edmonton is significantly better than other provinces like Ontario and BC. I will say that, but it
Yes.
still can take months. And that puts a lot of risk in my business. And also, if that risk is increased and there is potential problems and I have to get them out, now I'm definitely more involved and I'm investing more of my time into this. So I want to reduce that as much as possible. So I play an active role in who rents out my properties. However, that is the only part of it. And so what I do is I delegate all of the other things out. So I never go to my properties. I hire that stuff out. Okay. Everything else in my business, I delegate so that I can focus the most amount of my time on the $1,000 an hour task and less on the $15 an hour task. When it comes to screening tenants, I'm involved in that, but everything else, $1,000 an hour tasks. And as I started building my business and as I started, building equity in my portfolio, I was able to access that equity and start investing it more. Sorry, let me rephrase this. In the beginning, you're going to have to do a lot of $15 an hour tasks. It's just get used to it. You know what I mean? And I
Yeah.
don't want people to come in with this this high belief in your worth. I agree. But in the beginning, if you don't have $1 million to start investing in on day one, you don't
Yeah.
have money to trade. You're going to have to trade your time. Okay. And a lot of those tasks you're going to be doing are going to be low value. Just get over it. But if you can do that for a year
Yeah.
or 2 years and then build up equity and capital, then now you have money and equity to trade, and you can trade that as opposed to trading your time. Okay. Once you get to that stage, yes, as your equity grows, as your value and your worth grows, then the things that you focus your time on every day should also go up in value as well.
question for you there with regards to sort of the risk management side. You mentioned pulling out equity. What do you recommend for, the mentees that you coach, or even just a standard rule for yourself in terms of this is the ideal point to leverage up until, so that you're not risking sort of just market changes wiping you out, or leaving too much equity into a property where you're not maximizing your return on that as well?
Mm-hmm. It's a really good question because there's a couple different ways I can go at this, but I do just want to say that generally speaking, the default would be like 80%, 80% loan to value. I don't like going above and beyond that. Anything above and beyond that. So you won't be able to get more HELOC or line of credit on a property more than 80% anyways, because that's what most
Yeah.
lenders will go up to. If you want to go above and beyond that, now you're getting into private lending, private mortgages, where they'll let you go up to 100% loan to value or even more in some cases. But those private lending contracts or lending agreements normally come with like really high interest, 15%, 20% interest. And I personally just don't recommend that. Unless, of course, you've got a very short-term thing where you're going to get your money in and out. But if you're planning on pulling money out and investing it into a new venture, like a new business or a new property, it's not going to be profitable if you're paying 15% interest on it yearly. So generally speaking, what I would recommend always is to make sure to go up to 80% loan to value, but that's not for everybody, right? I think that the next thing that you really need to understand is, and this is a very common question I get, is like, I don't want to over leverage myself. I've heard about people over leveraging themselves, but when people explain that to me, what I find is that there's a lack of understanding and knowledge of what debt is and
Yeah.
equity. And so some people think that, when maybe they heard about their uncle who got a second mortgage on his house and he bought a boat, and then he couldn't make the payments and he lost his house. That's what people kind of think about when they think about debt and equity, second mortgages, lines of credit and stuff. But if you understand, if you
Yeah.
had a house, right, and it was worth $500,000 and there's a $400,000 mortgage on it remaining, there's $100,000 worth of equity there, right? That's
Yeah.
80% loan to value. So if for some reason you were unable to make your payments on this afterwards, you would sell the property for $500,000 for what it's worth. And of the $500,000, your lawyer would pay off the $400,000 mortgage. And then there would be a check for you for $100,000. That's your equity. So as long as you always keep a little bit of equity there, you're okay. Now, if that $500,000 house now went down to $400,000 overnight, it went down 20% in value, which, by the way, doesn't really happen since 2008 in some markets, right?
Yeah.
Like maybe went down 20%, right? But as long as you're investing in really good markets, you're okay. But if it was like a worst case scenario, catastrophic event, then just don't sell the property, right? And if you did sell it for $400,000, you would get the $400,000 check, you'd pay off the $400,000 mortgage, and you would have nothing left, but you wouldn't owe anything. You wouldn't be in the negative. You would just walk away, break even, right? So just understanding that simple concept would probably give people a lot more comfort around understanding it, and then being like, okay, cool. It's not a matter of like how much equity or what my loan to value should be. It's more about just like understanding that, and worst case scenario, if something happened, what would I do? So that's why I kind of go back to always buying long-term, buying whole cash flowing properties, is because if this property has got strong cash flow, meaning the revenue or rent that's coming in pays all the expenses, and then there's some left over afterwards, that's a nice big
Yeah.
cushion that it doesn't matter what hits me. Let's say interest rates go up and the mortgage payments go up, I still got room. Let's say rents come down, I've still got room. That's my cushion.
Yeah.
That's my risk mitigator. So as long as
Yeah.
you're always investing that way, it doesn't matter if my house goes down from $500,000 to $400,000. It's temporary. I look and I'm like, well, that sucks, but it's temporary. I can still continue to keep renting this thing until the value goes back up again. It's not going to be permanent, right?
Yeah.
So just understanding that and making sure that you're sticking to the fundamentals that we teach of real estate investing, you'll be fine, right? And there's always going to be things that come around and punch you in the face or punch you in the back of the head because you never see it coming. You never see oil
Yeah.
prices coming. You never see the
No.
housing crisis of 2008 coming. You never see the pandemic coming. You never saw the interest rates coming and the super inflation. You never saw any of that coming. We never saw Trump tariffs. It just seems like every 2 years, there's someone coming
There's
along
something.
and punching us
Yeah.
in the back of the head when we feel comfortable. But yet,
Yeah.
my portfolio has been fine for the last 10 plus years and I've never been affected because of
Yeah.
the way that we build our portfolio, the way that we build our business. Now, many people, Elray, you've been around for a while now. You see many people have been doing really, really well. They come up, they're doing great, and then they're gone. They get wiped
They're
out
gone.
the second any of
Yeah.
these catastrophes happen, right? So this is why it's important to stick to these fundamentals. And this is why my students have lasted so long, is because of the fact that they build it right, and they build a strong ship, and then whatever they go out to sea and whatever storm they run into, they're fine, right? So taking all
Yeah.
that into consideration, you know, as far as like how much loan to value or how much money you should borrow, just make sure that your business has cash flow. Make sure that any new ventures that you do and any new properties that you buy has cash flow, and you'll be fine, right? And it doesn't matter if the values go down temporarily, as long as they always go up over time, which real estate does, you'll be just fine.
I really love that you mentioned that, because that was going to be sort of my follow up add into that is it's the cash flow. Cash flow would be the life vest that you have to sort of weather it. Because you're right, real estate is cyclical. It could go down temporarily, and who cares what the value is if you're holding on to it and you're not coming out of pocket. The big thing happens is if you scaled up and you have cash flow negative properties across the board, and now it starts becoming an issue where you can't hold on to it. But I do have a question for you, because, I think oftentimes, and I find this a lot more with newer investors, is cash flow is just the fixation point. Like, how can I get the best cash flow? But we both know if you're looking for the best cash flow in home here in Edmonton, you can go find a triplex in Macaulay, and the cash flow is going to be amazing. But a lot of that is also potentially on paper as well, right? Because you're not going to see the vacancies, the tenant turnovers. And if you are going to get tenants that are going to live in there, they're not going to feel safe, so they probably move out. Or if they do feel safe, what kind of tenant is that? Are you going to be fighting to get your rent paid every month? So what are some things you look at to ensure that you get enough cash flow, but that you buying in a good portion of the city, a good neighborhood, a good property type, so that you see a lot of the upside on the appreciation, on just the management not being as intensive, it being an easier property to hold, all of those other factors, while ensuring that you still have a healthy cash flow to keep you afloat with all of these market swings.
Mm-hmm. Tenant profile is super important. So that's one of the 5
Mm-hmm.
fundamentals that I teach, and is making sure that
Love
you're
that.
choosing good clients. In fact, well, obviously we choose our market first, but then when I look at a market, I'm like, who am I going to be renting to? Just like any other business that I own, I'm always focusing on who I'm selling to and then reverse engineering that. So the person that I want to sell to, what do they want to buy from me? What problems do they
Yeah.
have? So they need housing. Where do they want to live? Those types of things. Then I look in those areas and I try and identify unique opportunities that cash flow, that fit the fundamentals, the other fundamentals that we follow for our business. So client first is very super important. Now, to go back to the whole cash flow thing, I don't buy in bad areas. I do own some properties that are in quote unquote questionable areas, but that were
Yeah.
higher risk, but also we had higher reward on it. And I was able to kind of like protect ourselves from that, making sure that the cash flow was so incredibly good that even if it took a big hit, we're still good. And we've done very well on those properties, very, very
Yeah.
well. We saw the upside in it. But generally speaking, I buy in like rental type areas. They're not, the house overlooking the ravine or the river. These are areas that are like where working class individuals work, where most tenants live. So like the B's or the C's, more of the C areas for rental properties,
Yes.
because that's my tenant profile, right? The
Yeah.
tenant profile is your working class individual, your trades worker, your warehouse worker, your nurse, right? The people who are making about $100,000 to $150,000 a year in combined income, right? Most of those people, that's who I'm looking for. That's my target. So with that being said, I choose areas that are suitable for that. Now, to kind of talk about the whole cash flow thing, I just want to clear something up. I do not live, and I never have lived off of my cash flow from my rental portfolio. In fact, I
Yeah.
would encourage most people just to forget that. So, this might be the first time you've heard this, and I'm sorry to be the bearer of bad news, because every other podcast you've ever listened to has said, cash flow, live off the cash flow, buy rental properties, be financially
Yeah.
free. It's a great way to sell tickets. It's a great way to sell
Yes.
programs. Okay. I'm just being real with you. I have my own coaching program. I don't do that shit. And it's probably
Yeah.
why we don't have 1,000 members across the country. It's because we actually tell the truth. And by leading people on and creating that expectation or that belief that that's possible, what you're doing is you're setting people up for failure and you're just taking their money. And I don't personally believe in that. So the truth is that you can live off of cash flow from rental properties. There are properties that have great cash flow. My properties have tremendous cash flow. However, anything can happen. Housing crisis, oil prices, COVID-19, interest rates, tariffs. That's just in the last 20 years,
Yeah.
right? It's it's too risky. It's just not worth it. So I realized as my cash flow was growing, as my portfolio was building up, I actually got to a point where I could leave my job. And then I looked at it, I'm like, this could go away at any time. And this was before pandemic and before interest rates. I said, I'm like, what if my tenants don't pay? What if rents go down? What if interest rates go up? These are very like not probable, catastrophic events, but I don't want to have to be at a point where I need to crawl back to my employer and say I need my job back. So I wasn't never going to do that. It
Yes.
wasn't worth putting my family's finances at risk. So I just said, you know what? Let's keep all the cash flow in there. Let's let that reserve build up. And then I know I'm covered for anything that could ever possibly happen. But when I
Yeah.
learned that and I realized, okay, this doesn't exactly fit the plan of what all of these gurus were telling me when I was, going to those events, I realized, well, how am I going to become financially free? And what I did was I looked at my portfolio and I saw the equity there. I'm like, there's all that equity just sitting there doing absolutely nothing. I've been planning on buying more and more properties to scale up my portfolio, which will create more cash flow, which creates more appreciation, increases my wealth. Why don't I instead figure out, okay, this is a good sized portfolio for me. Now I want to start borrowing the equity and investing it into cash flowing businesses. That's the key. So if you invest in a business that cash flows really well, then you can put all of your energy into the business now. My portfolio, automated. It doesn't take much work except for filling vacancies. It's just those little $15 an hour jobs. Otherwise,
Yeah.
I don't spend much time on my portfolio. My wife manages it maybe an hour or two a week, depending on what pops up. It's always reactive. It's never like we don't have to do that much work. But me, I focus on my businesses now because my businesses are what provide us the cash flow that pay for my living expenses. So if you can build it out this way, build up your portfolio, pick away at it, joint ventures, creative deals, build up that equity, and then borrow it over here and buy businesses, good cash flowing businesses. Then you can leave your job. In fact, you can
Yes.
do it probably in about 5 to 10 years. It's not that unrealistic, depending on how hard you want to go, of course. Everybody's going to be a little bit different. But I say if most people were just to pick away at it and buy a property a year or two properties a year with joint venture capital, within 10 years, you should have enough equity. You can borrow against it or sell those properties, buy a business, and then leave your job and manage the hell out of that business. Right. And so that could be a business that
Mhm.
you are kind of like a franchise and maybe you're not managing it, or you can leave your job and become an owner operator, build it up to a point where you can exit out and just have it managing yourself. But that's my personal belief for cash flow. Don't
Yeah.
expect real estate to pay for it. It can, but it's not sustainable and it's not worth putting your
Yes.
family's finances at risk.
You're absolutely right. It is what's sold is, cash flow. And then again, a lot of new investors that I speak to, it's like, that's the goal. Because you also, what's the long-term goal is to have enough properties, have enough cash flow that I can just quit my 9 to 5 and live off of that. And it's very, very dangerous advice to be giving people,
Yeah.
because anything can just wipe that away. And now you risk losing all of the properties. You don't have a job. You need to go back into the workforce and try and find something. I really love the fact that you highlighted that. It's not as sexy as
Nope.
saying, hey, buy a bunch of cash flowing properties and then they just pay you while you do nothing kind of thing. But it's the
And
truth.
don't get me wrong,
Um,
outright, like me saying this is terrible for business. When you're in the
yeah,
business of selling education and courses stuff, it's not good for business.
yeah,
But I feel obligated to tell people the truth. And what it does is for most people that are like, no, I want it. I want to listen to the other guy. They will go and join another program. That's great because I don't personally, no offense, I don't want to work with those people anyways, because they have unrealistic expectations and I'm not going to sell them on a lie. I'm not going to do it. I'm going to tell them the truth. What that actually does is it attracts the right people to me and the people that actually
exactly.
can understand it. And those are the people I want to work with because they're actually willing to be coached. They're coachable
Yes.
and they're actually looking at the facts and not the gimmicks. So I want to work with the people that are actually going to put in the work because I
Yeah,
know that those people are actually going to be successful, right? I do not want to bring
exactly.
people into my program, my expensive program, just for them to not reach their goals and then pout and then run away. And to be honest with you, just from an ethical perspective as well, even if
Yeah,
I was to take their money, I just don't feel very good about it. You know what I mean? That's not what I'm doing this for. I'm like, our coaching and education is not about, making lots and lots and lots of money. My other businesses do that. This is about me helping people to give other investors or other families the guidance and the mentorship that I wish that I would have had early on, because I had to learn all this myself because the gurus told me different, right? And I don't believe that that was fair. So what I'm doing is I'm making sure that people have the right education, the right people who understand it will find me, and then they'll get value from
I love that. Yeah, 100%. And it makes sense. It makes sense on so many levels because you get a bunch of people in just to get as many students as possible. Half of them don't do anything with it. So now your conversion rate of, hey, I'm able to take people who are trying to get started and get them up and running just drastically decreases. You have a bunch of people complaining and, now you stop enjoying what doing and stop getting fulfillment out of, I'm actually able to transform the people that I work with. So
it.
I fully get that. Now, I'm trying to put this in a way for people listening to sort of understand now. Up until where we've gotten to is, I like the fact that you start consumer or client first, right? Who's my client? You never like come up with a business idea and this is the product or the service that I'm going to provide. It's who am I providing this to? Who's my ideal client? So who's my tenant profile? So once I have my tenant profile, I know what property types I'm looking for. I know what parts of the city I'm looking for, right?
Mm-hmm.
Now it's finding properties that would cash flow. And this is where a lot of investors can get stuck is when they're running their numbers, it's, you're told to be conservative with your numbers. So you're adding in buffers, but then sometimes that sort of breaks the calculation, stops
Yeah.
working. Now they don't know. Have I been too conservative with the numbers, or am I being too ambitious and now the numbers aren't going to work in reality because I'm just getting started? I don't have confidence in all of this. What advice do you have for investors who get stuck at this point?
This is going to sound like it's a sales pitch, but it's not. Get a coach,
Yeah.
because I think that a lot of this, the uncertainty around it is just a lack of understanding. And it's also a lack of experience. And the only way to get over that is to have experience doing it. The only way to get the experience is to actually do it. So you got two options. You can just go and do it and hope for the best, have faith, and then learn your lessons, or you can pay someone who's already done it and they can help you avoid all those roadblocks. So and again, this is used so much in like the sales game for like getting people. It's not the case, but I'm just telling you that's option A and option B. So me personally, I'm all about investing. Anything that I do, I would rather pay someone to get through it faster, right? And to avoid all the mistakes. That's my personal belief. But I got money, so it's a little bit different. Not everybody has it. I can see it because there's so many people that are like, I've got $30,000. I worked my butt off for the last 3 years to save this. And you're telling me I got to put half of that into your coaching program just to learn how to avoid mistakes? What am I going to do if I have to? And what money am I going to use to invest? So the
Yeah.
option is, do you buy one property and potentially mess it up? Or do you buy no properties, go to a coaching program and learn how to raise money, how to analyze deals properly, and then go that route? My personal opinion, I think it's better off. It's inevitable that you're going to need, each and every one of us are going to need to raise money at some point. Because after you buy that one property, you're out of money. So you have to learn how to raise money anyways, if you're planning on scaling. So if you're going to put all your money into that first property, which is very highly probable that you're going to make mistakes and lose money, you still have, even after that, you still have to learn how to raise money anyways. So why not just skip that, go right to learning how to raise money? There's no difference. You might as well learn how to do it properly, raise money properly, because it's the inevitability of real estate investing, and people just don't realize this.
Yeah.
Everybody wants to do it with their own money. They want to save $20,000 a year and buy one every 5 years. I know I was the same person. I did not want joint venture partners, but I came to the realization one day it's just inevitable. So the sooner you learn how to raise money and market yourself as an expert, the sooner you're going to actually start growing, as opposed to putting all your money into one property and hoping for the best. So that's the truth, man. It's if people could come, if I can just shift a few paradigms today, maybe one or two people get it, great. Do you have to do my coaching? No, do any coaching. Find someone that works for you. You know what I mean? Find someone that resonates with you. That wasn't the point. But I highly recommend doing your research, doing your diligence, and finding the right course that gives you everything you need to know about becoming a successful real estate investor with someone that you like, and then going that route, that avenue. That's wisdom. That's the best advice I could give you.
Oh, absolutely. And the way I see it is, if your wealth isn't where you want it to be, or your income isn't where you want it to be, it's sign of just one thing, and it's skill deficiencies, and it's lack of knowledge, lack of skills, right? So if you could build up those skills, to be able to get there way quicker. And that's where a mentor and a coach really comes in, because they see and they've seen the roadblocks that you have. They've overcome all of those things. They have hindsight, so they can advise you. Now, if you look at people who are doing this on a higher level, like how many of them I'm saying, yeah, no, I'm just saving up for my next down payment, trying to
Mhm.
build up that way. No, oftentimes it's not a lack of money, it's a lack of skills. So paying for those skills with someone who's gonna give you ethical advice and give you proper coaching and proper guidance, in my opinion, is way more worth it, because the time and money that you save shortcutting all of those lessons versus learning in the hard way is far outpaces it. So no, that
Mhm.
makes a ton of sense. Now, not that we're trying to promote any courses or coaching yet, but I think being able to speak to someone who's been there, done that, will absolutely save you a ton of headaches, a ton of time, and a ton of money. So, you pay for your education, you could do it the easy way or the hard way. I firmly
Yeah.
believe in that. Now, Wayne, if we go to people who are like, hey, this market seems like it's got a lot of opportunity. I'm just struggling to sort of separate opportunity from hype, you know,
Mhm.
and when competition's at its peak, how can I tell if this is just someone hyping this great deal on Facebook, or if this is actually a good opportunity? Now, I know you're going to say it's going to go back to the fundamentals, but maybe if you can highlight some
And
of
a
the
coach.
fundamentals for people listening out there, and the coach, exactly. But if
Yeah.
you could highlight some of that for people out there, maybe you want to list, some of the fundamentals, or just a high level on, things that they should be going through mentally, or even, you know, actually working with maybe a calculator, or doing some due diligence, some
Mhm.
check boxes that they need to run through to ensure that they're not looking at this from an emotional standpoint, because they've been sold on this hype, and actually that, hey, this all works. This is a good opportunity. This is something for me to hop on, because as we both know, in a market like this, speed makes the difference, right? But you don't want to skip due diligence just for speed and make a ton of mistakes. So what are some things
Yeah.
people can consider?
Well, just on that note, the market that you're referring to is the market that we invest in mostly, and that's Edmonton. And yeah, we are in one of those markets right now that everybody is like, there's multiple offers. We haven't quite seen the prices go up this spring yet because it's still early in the spring. But with these
Yeah,
multiple offer situations and a lack of inventory,
it's
eventually
coming.
what's going to happen is all of these multiple offers are going to be doing over asking. And then that over
Yeah,
asking sale price is what's going to push the market up this spring. And we've seen this coming, and I've been watching very closely, and we knew
yeah,
that this was going to happen. So it hasn't been realized quite yet, but as it continues to get worse, it's the prices are going to keep going up more and more, and the competitiveness is going to increase as well. So for right now, it's you do have to stick to the fundamentals, right? That's I know I sound like a broken record, but that's just the truth. Now the
yeah,
cycle that we're in right now is a very competitive markets, and therefore you do have to act fast, and you do have to write creative offers, and you do have to write um you need to be very strategic about making sure that you get deals, otherwise you're going to miss out. But I'll be honest with you, and maybe I shouldn't say this, but typically, if in this market, if you can't get a good deal, then don't buy. And I know this isn't very, you know what I mean? Like, I know nobody wants to hear this, but seriously, if
yeah,
you have to pay $40,000 over asking and you're concerned about it, then just don't buy it. I would
yeah.
say, I would encourage you to write more offers and find those diamonds in the rough, or find those unique offers that nobody else sees, and being able to spot those unique opportunities and focusing on those and getting the right deal, as opposed to paying over asking because you feel like, if I don't do it, I'm going to miss out. Right.
Mhm.
So ultimately, I recommend that you stick to your guns and stick to whatever the criteria is that you said that you were going to do. And remember that this type of market doesn't last forever. Okay. It will eventually shift. And when it does shift in a downward direction, and all the hype and all the people are saying, oh, the market's bad right now, I need to get out, that's when you buy. If
Yeah,
you look back, if you follow me on Facebook or on social media, if you look back to June of 2023, I wrote a post and I said, now is the time to buy rental properties, because we were right in the bottom of it and we were starting to go up a little bit. And I'm like,
yeah,
you know what? There's no competition right now, and we could buy cash flowing properties, but nobody
yeah.
wanted to because they were very uncertain about the interest rates. And there was a lot of,
Hmm.
should I, shouldn't I? When's the rates going to be coming down? Right now is the time to buy, because I
Yeah.
knew that once the rates came down, we were going to get right back into what was happening in late 2021, 2022, before the rates went up, which was we were in this direction, right? But
Yeah.
it stopped and it halted and it went down because of rates. So I said 2003, now is the time to buy. Buy as many rental properties as you can that cash flow and then ride the wave as it goes up. And sure enough, it did, right? So
Yes.
there are times to buy and there are times to hold, okay? And sometimes there's times to sell as well right now too. Not quite. Wait until everybody's like going absolutely crazy and the babies are crying, the mom's holding their baby and they're like, "Oh, am I supposed to get a home?" Like wait for those. I know it sounds terrible, but that's what you want to wait for, those big news articles that like it's crazy.
Yeah.
Investors are flocking and ruining our market and prices are up 50%. Sell then when everybody wants to, because then you get the best if you need to sell,
Yeah.
right? As long as that's your plan and it's not a long-term buy and hold plan, right? But that's when you sell, right?
Yeah.
So right now we're in a weird spot right now where I think that it hasn't quite been realized yet that the prices are going to go up like crazy. They have gone up and not up. So now there are opportunities, but make sure you stick to your guns, stick to whatever you said your buying criteria, and stick to your checklist and focus on that. And if you can't, then just don't. Just be patient. Patience is the most important.
One thing I find is that really helps, investors that I'm working with is if they get clear on their property type and their buy box, right? So that they don't have shiny coin syndrome and they're all over the place. So it's tough to really see if a deal's a good deal. But oftentimes, and even in this market, realtors have different pricing strategies when they list a home, depending on the seller and their marketing strategy. But, they could list it at market value and, sell it for the average days of market. They could list it above to account for someone negotiating. And, that ends up being the case. Or they could list it slightly below market value, or obviously below market value, and then it just rises up to way above list price. So sometimes for new investors, it can be tough to distinguish market value to list price because
Yes.
you're only seeing what it's listed at and not what it's actually worth. So like one thing that I do as well, like is I recommend for people out there who want to really capitalize on it is don't shop on realtor.ca. Have like a dedicated search set up with your realtor so that you're getting notified as soon as possible. So you can kind of try and get ahead of the crowd, but also have your agent set up a sold portion for that same criteria within like at least maybe the last 7 days. You don't want to be overwhelmed with listings, but those properties that you're running numbers on and that you're looking at, you get to see what they actually sold for. So you get a better idea on what the actual market value is, because it's all perceived market value until a buyer pays the price that a seller is willing to agree, right? And that can really vary, I've noticed, depending on who that buyer is. Maybe there's someone coming in from another province. Houses are cheap this side, they're willing to pay more than an Edmontonian, you know what I mean? So, but you get a better idea for where that
Come on in. Like you keep
market
picking
value is at.
for properties. As long as you own the properties, we're loving it.
Exactly.
I love it.
And so that's honestly one thing that helps, but getting clear on what your buy box is so that you know when something hits the market, hey, this looks different. Is there something wrong here? You can analyze it. You're like, why is this lower than all the other properties that I've been running the numbers on? There's something here, you know what I mean? And you can act a whole lot quicker. And then make sure that you, like you mentioned, not getting emotional with the multiple offers and just, I have to get this, and going outside of where the numbers allow you to get it at. Yeah, no, I love that. And you're right. There was that moment in 2023 when it was just perfect to be buying. I noticed this. I even noticed this with listings that I had. Was 2024 kicked in and it's like there was just a switch that was flipped. And, the market just started going crazy from there. But no, all great advice.
You just got to understand those trends, man. That's it. Like it's again, looking at the history of things and just how are people going to react? How are tenants going to react? With the immigration and the lack of supply, how are investors going to react? How are home buyers going to react? If you can start studying people, then you'll get a better understanding of how they react, which is what creates the market. I've been saying this a lot lately. There's no cosmic being that's like determining what market rent is and market prices. And there's no watcher up there just like determining how things go. It's human behavior. It's how people react to things. So study humans and study how they react to things, and you can get a good idea of where you think things are going to go. And then you can strategically place yourself safely with a good, strong, business with good armor and a good moat around it. Okay. But,
Yeah.
put yourself in the best possible position to get the best possible opportunities. And I'll tell you right now, in today's market right now, am I personally buying? No. Unless I can find something that's like really obvious, I'll do it.
Yeah.
But am I buying right now? No, I'm not going to compete with everybody else and their unrealistic, offers and whatnot. No, I'm just being safe.
Yeah.
But what I am doing right now, what I've been doing since September of 2024, I've been watching the market very closely. And I've also been looking for what's the next unique opportunity. Because especially
Yeah.
in Edmonton right now, there's a lot of Edmonton investors. I'd say 95% of the people that are calling me or reaching out to me are asking about Edmonton because they know I'm an Edmonton expert. And what I'm looking at is that, okay, cool. Cash flow is starting to go away because prices are starting to go up. It's still there. We still have cash flow. Don't worry. But what's going to happen in the next 12 to 18 months is cash flow is going to go away because the prices go up too much, the mortgage payment goes up, and the rent's not going to be able to keep up with it. Now, my portfolio would be fine because I bought them at a lower price point, right? Lower mortgage payments. I'm okay for the next 5 years. But as that starts to happen, where are we going to be investing our money? What's the next big thing? MLI Select, well, half of the MLI Select type products,
Yeah. Yeah.
are under not working right now because of the single family homes. I'm not going to get into that, but
Yeah.
we're also seeing that the projects that do work under MLI Select financing at 50-year AM, they're starting to get so incredibly overpriced that the numbers don't make sense anymore. They're not even hitting the debt coverage ratio. So not able to debt service it. So your whole 5% down thing's not working anymore because most people got to put 12 to 15% down now. So
Yeah.
that's going away as well. And as these things start to go away and as we come into a different cycle, what's coming now? And that's what I've been putting all my effort on for the last 5 months. I'm not going to say what's next, but I'm going to
Damn
put
it,
it on
Wayne.
record. And then you got it here and you remember this because in 12 months from now, when you see what Wayne's doing, after Wayne gets all the benefit from it, you'll understand. And this is
Yeah.
what I mean. Like you have to study and you have to look for those unique opportunities because every market cycle has their own unique opportunities and you need to be able to spot them before other people. And if I say it out loud right now, then everybody's going to jump on and I'm going to miss out. So I'm not going to do that. But pay close attention and start
Okay.
getting an education so you can spot these opportunities yourself. And kind of going
Yeah.
back to that whole following the herd thing. You know what I mean? Do you really
Yeah.
want to follow the herd? When you follow the herd, that's somebody who's already a year to 2 years ahead of you. They already saw that before you did. They're doing it. And then you saw other people do it and you're like, oh, that looks pretty good. You're 2 years behind. I got people that are still trying to do burrs on townhouses in
Yeah.
Edmonton. I'm like, I was teaching that in 2021. Yeah, but everybody
Yeah.
was doing it. And I saw your podcast in 2023. I'm like, that's 4 years old. You can't do
Yeah.
that anymore. It doesn't work. You have to be able to spot those things ahead of time. So when you follow the herd, you're like the last person at the party as everybody's leaving. It's just it's not a good strategy. You have to get good at recognizing those opportunities yourself. And the only way to do that is to get experience and education. Plain and simple.
I know that. I want to mention that the townhouses have seen a massive increase over the last year. I want to say year over year it was like 21% or something ridiculously crazy. But it's crazy that and that's one of the things you were mentioning a while back. But I was hoping you would spill some tea here and tell the people. But for people out there who are like, okay, Wayne, you know what? I'll go and I'll do the hard work to try and figure that out. Let's see if I understand correctly. It's having a good understanding on the economic side, maybe because real estate is supply and demand, trying to get a good grasp on what's potentially happening with interest rates, trying to predict some of these unexpected things that are going to pop up. It's understanding the macroeconomic side of things, and then it's understanding human behavior and how they are going to react to these events as they transpire and predicting that so that you can capitalize on how you predict things are going to go. What are some things people can do to try and spot that next opportunity, whether it's a different property type, it's a different strategy? What are some maybe mental check boxes that you run through when you're trying to look for that next opportunity?
Okay, so there's two, and I'm glad you brought up strategy because what you can do is you can get creative. You can utilize some of the other creative strategies, and that could be seller financing strategies, that could be wholesaling, fix and flipping and stuff. There's lots of different things you could do with real estate. So in different cycles, it might not be a good time to buy, but it might be a good time to flip, right? Or buy and hold. It might be a good time to flip. So maybe flipping is the right thing to do. And in a market like this, when everything's going up, yeah, it's going to be super competitive. You're going to have a hard time trying to find a good deal. But if the market's always going up, you can make some money in fix and flips, and everybody looks like a fix and flipping genius in a hot market until the music stops. So be super careful. And this is a whole other discussion about risk management for fix and flip businesses, because I can tell you in 2022, the door closed on me, and it was very, very close. I got out. A lot of people didn't get out because none of us saw the interest rates going up like they did, right? So I was holding properties in July of 2022 when the interest rates started going up, and that did not feel very good when you had all of these fires and then they all just went. So making sure that you have good risk management systems in your business for creative strategies. But fix and flips, rent to own. You can also get into seller financing stuff, right? You can get into adding secondary suites. You can get creative. That's one option, is start learning the creative strategies. Again, stuff that I teach. Start learning those creative strategies so you can start recognizing, okay, this isn't going to work, but what if I add this creative strategy to this? Suddenly it makes sense, right? So adding creative combinations together, different creative strategies, is a really good idea for taking mediocre or crappy situations and turning them into great situations. So that's one. Number two is pay attention to what investors do and what homebuyers do. Just going back into studying people and human behavior. What's going to happen? And I will give you this one for free. And I literally just gave it for free on my own podcast the other morning. I think it was Monday or Tuesday, where someone asked, well, what's next then? And I said, fine, I'll give it to you for free. I'll tell you exactly what investors are going to do next. Oh, that's a good one for that little bleep thing. You do the bleep
there we
thing?
go.
Yeah, do that bleep thing. Okay, cool. I like this. This is good. Drum roll. Okay, suspenseful moment. What happens when, okay, let's just do a little bit of history. Where were all the investors in 2019 and 2020? In a little province called Ontario, right?
Yeah.
Big province.
Oh, yeah.
Center of the world, center of the universe, Ontario. I'm from there. That's what they teach you in grade school. What's the capital of Canada? Ontario. Okay, so that's where everybody was because it was working. Yeah. You had cash flow because the prices were nice and low, the rents were decent, and the prices were going up like crazy. What happened when the music stopped in Ontario? Where did everybody go? They went west and they went to Calgary. Yeah. They're like, okay, I heard Calgary's good. So they went to Calgary. What happened in 2022, 2024? Calgary went up like crazy. What happened as soon as it stopped and as soon as it didn't make sense anymore? The cash flow wasn't there. They went down Highway 2 or up Highway 2. Red Deer, Edmonton. Yeah. Edmonton was next. I don't think that they were planning on Red Deer. I think they stopped for gas and a hot dog and they realized, oh, wow, there's a city here too. It's actually pretty decent. And they started buying in Red Deer as well. But now they're in Edmonton. And what's happening? Yeah. Edmonton's going up. What happens when Edmonton dries up? Where do they go? Think. We've got all this investor capital from BC, from Ontario, from Calgary, now in Edmonton, because we're all rich now too. Where is all this money going to? What is very likely going to happen? I'll give you the free answer. Saskatoon. It's going to be Saskatchewan. It's going to be Saskatoon and Regina. You watch. Now, don't go there right now. It's too early. Okay?
Yeah.
Please. Like, this doesn't mean you're like, oh, I need to go buy in Saskatoon right now. You can, but like, you're going to have to be super, super patient. It's not going to be coming anytime soon. Okay? It's down the road. But when we think about it, we have to think about what other markets in Canada have a good price, have good revenue that creates that cash flow, that's not being utilized right now. It's no one's looking at it, and it has good landlord and tenant laws and good clients. It fits all the fundamentals. It's obvious, but no one's gone to Saskatoon yet because Edmonton is better. So they're gonna they're gonna basically mine the crap out of this gold mine here in Edmonton until there's nothing left, and then everybody's gonna go to the next one, and that's gonna be very likely Saskatoon and Regina, which we're already seeing it going up a little bit. But none of the big names have made it there yet. As soon as you start seeing me doing webinars on Saskatoon, or as soon as you start seeing me doing events there, then you'll know it's time. But then what's going to happen then? Saskatoon and Regina is going to dry up. Where are we going to go next? Think like an investor, or think like how investors think, right?
Yeah.
And then you can kind of predict what's next. Does that make sense?
Absolutely, it does. It absolutely does. So from my understanding that you were looking at, okay, favorable tenant laws, I guess you mentioned revenue and probably affordability as well being a factor. So those are all things that like where things progressing, sort of the path of progression, and trying to get ahead of the curve slightly so that you can capitalize on the upswing there. No, that makes a ton of sense. Honestly, Wayne, this is fantastic. I just want to keep it going, man.
I think this is too long. See, now the algorithm's not going to like this podcast.
It is. It's not.
An hour and 20 minutes long. But
I'm not
tell
sure
you what, man, you have me back on the podcast whenever you want. I got lots to talk about.
Absolutely. Maybe we'll do it when you start speaking about people leaving Edmonton and moving on to the next opportunity. But I'm not sure if we did this the last time though. But it's one of my favorite segments. I call it time capsule. It's where you imagine you stumbled across a time machine. You can travel back and forth in time, but you can't change anything. You could give and receive advice from your older or younger self. So if we had to go back to 18-year-old Wayne, young Wayne, I don't know if you were pumping gas at the time. Yeah, yeah. What
Yep.
advice would you give 18-year-old Wayne with the knowledge that you have now? It can be investing, personal, business, combination of them. Other than go find Gabby and marry her. What advice would you give 18-year-old Wayne?
Go west, young man, go west. I did. And it worked out really good. Um, I'll admit, and I don't want to ruin this segment for you, but to be honest with you, I don't like these types of exercises because I don't have any regrets in my life. And I
No, for
think
sure.
that if I went back and I played Ashton Kutcher and I did the whole, like, went back and told myself something, that whole
Butterfly effect.
butterfly effect thing, man, that's a
Yeah,
deep reference for the millennials.
yeah,
That that whole butterfly effect thing, man, that scares the shit out of me. I am incredibly blessed with everything in my head I have in my
I love
life
it.
and all the decisions that I've made. Um, and there is one thing I don't think I would change anything other than having a little bit. And this is getting all weird now, but
Yeah,
having a little bit more confidence in myself. And I think
yeah,
that early on, before I turned 21, I was listening to what other people were saying, and I didn't believe in myself. And it wasn't until I was 20, 21 years old that I actually realized that I can do this and I'm more than what people
yeah,
think I am. And that confidence is what led me to driving across the country in a U-Haul, moving to Edmonton, creating my career, meeting my wife a few weeks later, getting into real estate investing, starting my businesses and everything that I have today. So
love
I
it.
don't know if had I done it 3 years sooner, then I wouldn't have met Gabby because she wouldn't have been there. So I don't have any
Yeah,
regrets about that. The timing was everything that I have in my life is beautiful, and I have zero
yeah,
regrets. So I don't want to change anything. The only thing I would change is maybe just having a little bit more confidence in myself because those were a few dark years. You said I was 18 and I
yeah,
was pumping gas. All of my friends were going off to school and getting their degrees and becoming engineers and stuff. And everybody was judging me because I was going to school, but then I dropped out and I was pumping gas and I had nothing. I had no prospects whatsoever for my life. It was a bit of a dark spot in my life, right? And I'm thinking everybody's talking about growing families and creating their careers and stuff like that, and I didn't. So I would just probably, have a good chat with myself about just being a little bit more confident and not listening to people. And it's the same advice that I would give to everybody else as well.
yeah,
Is just have, you know what I mean? You should believe in yourself. If anyone's going to believe in you, it's only going to be you. All right. So
yeah. No, I love
you're
that.
you
But yeah, sorry. No, I was going to say, by the way, you can't change anything, even if you wanted to. It was just purely advice. But I think
mm,
that is solid advice, is believing in yourself and having the confidence to follow through on what you want to pursue. Because you just need to stick it through. And you
yep.
need to believe in yourself more than anyone else does. Because you are going to have people that love you that are going to doubt, what your capabilities are, given whatever your goals are. And you just have to have that so that you could stick it through and make it to the other end of it. So I love it. That's solid advice. Now, if you were to go forward in time and you go to 80-year-old Wayne rocking the gray beard, what advice do you imagine your future self would offer you at your current age?
I think they would say thank you.
For the most part, I tend to get people saying, along the lines of be more present, spend time with your family,
Yeah.
sort of the typical stuff. But is there
Yeah.
anything that you think older Wayne would say to you right now?
That's you're absolutely right. And it's so cliche. I was just trying to sound funny, but it's so
Yeah,
cliche.
no, I
But
get.
like, honestly, it's in the beginning years, as I mentioned earlier, you got to do a lot of $15 an hour tasks. And sometimes, that's pulling you away from your family. You know what I mean? You're going to work, you're hustling, you're doing meetings, you're creating all these side hustles and whatnot, and just to kind of create opportunities because we didn't have the money. I started with $15,000. I bought one property. It was my new house, and the first one became a rental property. That's how I started. That's it. Everything else is through creative seller financing and joint ventures and raising money. But I didn't have any money to start, so I had to use my time. And because of that, it put a strain on my relationship with my wife because she wasn't it wasn't her idea. It was my idea, and I just dragged her along for it. And then obviously I didn't spend as much time with my daughter. And maybe, I had time to spend with my daughter, but the time that I did spend with her, I wasn't present. So,
Yeah,
my big focus for the last ever since 2020 has been making sure that my time is valuable and making sure that I'm spending it on valuable things and investing not just on my business and my portfolio, but also into my family as well. And the last few years, I've been spending a lot more time with my daughter and making sure that we're connected more, is because I noticed that now she's 9 years old and she's not running to daddy after school anymore. You know what I mean? And there's only a few years left, I have of that relationship before it starts changing. And I know that when I'm 85 years old, that will be my biggest regret, hands down, my biggest regret.
I love it because it's so honest, it's so true.
Mhm.
And I think that's why it always goes back to the fundamental question when you getting started in anything, let's call it real estate, is what's your why? What's
Mhm.
your reason for doing what you're doing? Because it's so easy to get lost in more and more and more. And sometimes you forget why you're doing what you're doing. What's the end? What's the reason to it? And putting that into perspective helps you sort of calibrate, because you go through seasons, right? You go through seasons where your time is just required to get over that hurdle. But it's easy to get lost inside of that routine of just the grind culture and the hustle culture, which is not necessarily a bad thing. But I always think about this as reflecting, what would my future self say to my present self right now? And it just gives you a little bit more perspective to be a
Mhm.
little bit more wholesome with why you're doing what you're doing. Went away on vacation recently, and honestly, all I wanted to was get back into the swing of things. And I had to remind myself, like, why am I doing this? And then you look at the kids, you look at your wife, and you can see the joy on their face. And that's the reminder, this is why I'm doing what I'm doing. So just snaps you back into reality, allows you to be a little bit more grateful and be present and spend that time purposefully. Because you're right. One minute you're picking up your kids, the next minute you put them down, never to pick them up again, and they just go for it. And so you have to make the most of that. But Wayne, honestly, this has been fantastic. As always, you didn't disappoint. Um, you've left another segue for a future show to come. So I'm looking forward to the next one, that's for sure. I want to thank you so much for taking your time out and for sharing all this valuable insights. Now, for everyone out there listening, like Wayne mentioned a few times, he has a podcast. In fact, Wayne is so diligent with this. He wakes up every single morning, himself and Gabby, super early in the morning, to have a podcast episode every
Mhm.
single day. And you can actually go join in live and you can get your questions answered in real time. Super, super valuable. One thing I like about Wayne is he doesn't sugarcoat things. He doesn't tell you what you want to hear. He tells you what you need to hear. So I'm going to leave that in the show notes below. I implore you guys, go check it out. You'll find a ton of value joining in. And join in live if you can. That's where you get the best value, really. But Wayne, I want to thank you so, so much for coming on. Really appreciate you sharing. It's been fun, man.
It's been a blast, man. Thank you so much for having me on the podcast.
Thank you for tuning in to the Wealth Through Real Estate Show. If you're interested in learning more about the BRRRR method, learning how to legally sweep properties, screen tenants, manage those tenants, and keep things going smoothly so that you can scale up effectively, you absolutely want to check out the episode with Patrick and Alicia. This is your host, Alray Noble, signing off.